Hey guys, what's up? This is Tony from alphapursuits.com. In this video, we are going to talk about risk management for the wheel options trading strategy. As you know, there are so many different types of options trading strategies out there. And depending on the kind of strategy that you are trading, obviously your risk management has to change. So for example, if you are buying calls or buying puts, which I do not do because I like to sell premium rather than buy premium. So in those cases, you really need to think about, okay, how much I'm willing to lose, at which point I should get out. Maybe I need to have a stop loss, things like that. Now, with the wheel strategy, it is the same, but there are certain elements where we have to think about on top of that. What's the potential downside if we decide to hold on to it longer than we want to? Because a lot of the time with the wheel strategy, your thinking is, okay, this stock is going to go up. And so that, your intention is to hold it a little bit longer time frame compared to a typical speculative options trading. So from that point of view, you really need to start thinking about, okay, can I withhold this downturn? I have to look at it as a portfolio, as the whole account, not just one stock or couple of positions. You will need to really think about the whole picture here, and this is why I want to talk. This is what I want to talk about here, because unlike a single position trading, here with the wheel strategy, we need to think about, okay, what is the overall picture? So let's start this conversation with position size. Position size is basically how much money you're going to spend per trading order. So ideally you should limit that to only a few percent of the total account. And I personally like to limit it to 3%. I do go beyond that sometimes depending on the underlying stock that I'm trading. In some cases it requires me to go beyond 3% because of the price of the underlying stock. But even in those kind of situations, I try to limit it to around 3%. And the reason for that is because the market moves up and down all the time, and the implied volatility changes all the time. So a lot of time what I see is, even though the price of the underlying stock doesn't change today, because the volatility changes every day, I could get a much better premium by selling at the same price point. The underlying stock remains at the exact same pricing, yet the options premium that I'm selling could jump up, sometimes twice even, just because the implied volatility shifts from one day to the other so much. So this is why I like to keep the position size small, not just because it's safer, but also it allows me to get into, build up positions gradually, and in case I'm wrong, and I can take advantage of the underlying implied volatility, so I can get more premium out of it. Now the next one is position type. So obviously there are unlimited risk, limited risk, call, put, depending on what kind of strategy you're trading, the position type that you select could be different. And with the wheel strategy, we are selling put, which is obviously covered by the cash that we have in the account. But one thing to pay attention to is that if you're using margin, then you could actually go beyond the amount of cash you have in your account. So that's where you have to be very careful, and that's we're going to talk about that in the next section here about leverage, about margin. But with that, even though the wheel strategy is pretty safe in a sense, because it is covered when you sell put, it is covered by the cash in your account, and when you sell call, it's a covered call because you get assigned with a stock, and so that you are basically selling call against the stock that you own. And so that in this sense, the wheel strategy, it is pretty safe compared to some other strategies. And with regards to call and put, you don't really have an option here, unlike spread that when you have a very strong directional trading. Sometimes depending on the direction you want to take, you can use both call and put. But with the wheel strategy, we don't really have that worry or that problem, so to speak, because it's pretty straightforward. We sell put and then we sell covered call. That's it. So position type, we don't really have to worry about those two. But what we need to worry about though is the underlying stock, and especially which industry. So a lot of time there is a shift. The money flows in and out from certain industry to the other. And when that happens, what you will see, and especially right now, that's what I'm seeing with the screening process that I have. I'm seeing stocks from the same industry get their price get knocked down, and they just all declining at the same time. So, for example, oil stocks, multiple of them, especially the ones that might go bankrupt, showing up on my screener, and so you need to understand, okay, what is the underlying stock, which industry are they in, and why are they going down, and those kind of things, so that you don't get into the trading with just one type, one industry. You should ideally spread it out so that when the market turns, you don't sort of, not all of your stock are gonna go down in one direction. And that leads us into leverage, which is the next point, and especially people who are using margin accounts. So leverage, it's good to have, but it is also very bad to have if you're not careful, because what you can do is you can go beyond to the amount of cash that you have in your account. So what will happen is that it allows you to, buy a larger position size, a lot more different stocks, and it can go beyond your cash amount. When things is good, that's fine, because that means your account is gonna grow twice or 3 times faster than if you only use just the cash that you have. But imagine when it goes to the other side, you really need to pay attention to that, to sort of simulate and think, okay, what if everything goes down the toilet and all the stock that I own goes to zero or close to zero? Would I be able to withhold that downturn? Do I have enough cash, or do I have enough credit in my account so that I don't get a margin call? And so what I do is I set up my spreadsheet in a way that I continuously monitor the full leverage that I have. So obviously I use margin, so it's typically the leverage rate is more than 100%, and I try to look at the leverage rate and sort of see, okay, when it gets to 130, I start getting a little bit nervous. 150, 160, I would get really nervous. But it really depends on what the market is doing at the time. If the market is good, I would increase my leverage a little bit more because I feel comfortable. But when the market turns, I want to make sure that I have enough liquid credit in my account so that I don't get margin call. So that's something you will really need to think about and set up a monitoring system for that. Next, let's talk about delta neutral and beta weighting. So delta neutral is a very nice concept in a way that by making delta zero, in theory, it will make our account profitable disregard to the market direction. Because when you have a positive delta, which means when the market goes up, you profit. When you have a negative delta, which means when the market goes down, you profit. And of course, that's in theory, because depending on the setup that you have, if you're using put or call to speculate which way the market is going for you to profit, the positive delta and the negative delta can become very confusing. And not only that, there is also the time value that comes into play, also the underlining, whether it's in the money, out of money, the delta can change substantially. So when all these factors come into play, it is almost impossible in practice to make your account delta neutral. But instead, what we can do is use beta weighting against certain indices. In this case, I like to use XPX because it's a wide market index. It contains 500 stocks, so it gives me sort of a general status of which way the market is moving. And by weighting my entire portfolio, my account against that, I can see, okay, when the XPX goes up or when it goes down, my account will be profitable now. So let me show you in practice what that means on Thinkorswim. So this is what it looks like in Thinkorswim. As you can see, each underlying stock, it has delta number, and now we are looking at individual stock. So it's really relevant to itself, so to speak. And what I mean by that is, based on, because we are doing the wheel strategy, and of course, the wheel strategy, let me show you here. Here I have put, and so obviously when the market goes up, that's when I'm going to profit. So it's a positive delta. Whereas for the ones that I'm selling call, it's a negative delta because I'm going to profit when the market goes down. To make it more complicated, for example, for VXX, I'm selling call here. So in theory, when the market, it's a negative, which means when the market goes down, that's when I'm going to profit. But in reality, it is not, because VXX is inverse, so to speak. When the volatility goes down, generally speaking, that's when the market goes up. So I'm going to profit actually here with selling VXX call. I'm only going to profit when the market goes up, in theory, and in most of the time. So, how do we fix that? This is where the beta weighting comes in. So if you are in Thinkorswim, all you need to do is just click on that beta weighting button and enter the symbol. In this case, I have XPX in there. Now, once I enter that, you can see everything gets adjusted based on the symbol. So now VXX, like I just explained, I'm only going to profit. Well, most of the time, I'm going to profit when the market goes up, which is adjusted to positive delta here now because XPX, it's weighting against XPX. So by using beta weighting, I can see, okay, my whole portfolio right now is about 23 delta, which means I'm going to profit when the market goes up. And to prevent, market drawdown, when to predict in case if the market goes down, what I can do is I can set up some position with negative delta when weighted against XPX. to bring this delta number down closer to zero. So I have done this a few times by simply actually setting XPX spread, call spread. So by doing that, I will be getting a negative delta, and so that will bring the delta down. And obviously, when the market goes down, I basically profit from that, which offset some of the negative that I get from holding this short put positions. Okay, that's it for this video. If you like the video, give it a thumb up, share with your friends, and I'll see you in the next video.